Chip makers managed to escape specific tariffs in President Trump's new levies on imports to the U.S., but those stocks still got slammed today, along with the broader market. Joining me now is Gil Luria, D.A. Davidson Managing Director. Gil, always good to see you. So I'm looking, Gil, here at the SMH, the ETF that tracks the chips. It's down about 9% in today's trade, Gil, so it gets slammed. How are you thinking, Gil, about what these Trump tariffs do mean broadly for the chips, at least near to intermediate term? How are you thinking through it?
Yeah, there's several levels of impact. What we already know, there's going to be broad 10% tariffs on everything. So I think saying that there's going to be 10% price increases across the board or cost increases across the board is fair. Not a coincidence that stocks were down that much. But then there's the next level effect. So the next one is the reason semiconductors were excluded from the reciprocal tariffs wasn't that we're not going to tax them. It was that there's going to be specific regime for regulating and tariff around semiconductors that we don't know about yet. So we will learn about it. It is very likely to include China and restrictions on China. So we will find out about those, and those will probably make it even worse. And then the next order effect is what an overall slowdown in the economy is going to do to demand. Let's not forget that when Microsoft, Google, Amazon, and Meta embarked on this journey to do this huge build out of data centers, their core businesses were doing very well and generating a tremendous amount of cash. And they were willing to make this speculative bet that AI is going to generate fantastic returns in the next several years. If the global economy weakens, demand weakens, their core products have less cash to produce, they're less likely to want to be on an aggressive path towards building data centers that are only going to pay off many years in the future. And that is going to have an impact on the semiconductor space as well. So I think those are the levels of thinking that we need to have right now as we find out what's next.
So the data center side, Gil, but then are you also saying, just to make sure I'm understanding you right, that we also have to be concerned about all the products that chips go into on the consumer side too, smartphones, PCs, autos, because they are getting tariffs. So as those prices get up, we have to be watchful for demand destruction there?
Yeah, absolutely. So there's the 10% across the board tariffs, but when we're importing iPhones from China, the tariffs on those are going to be far higher, or any consumer electronics that we're importing from anywhere, which often does come from China. Those tariffs are going to be very significant and put the manufacturers and the brands in a tough spot of either absorbing the tariffs or raising prices very substantially, which will have one way or another have a dampening effect on demand.
Do you think, Gil, we're talking kind of near to intermediate term effects here. Long term, do you think all this could result in what Trump really wants here, which is this ramp, this increase in domestic chip manufacturing?
Well, you just reported TSMC going to build more in here, going to partner with Intel to do it. That is what the administration wants. And this is something that's been in the work for a few years. But these are very long-term investments. These are investments that pay off over decades. And the administration needed to make it clear to these companies that this is the new regime and they need to start making more of their product in the United States. We're doing it for a variety of reasons. Many of them have to do with our national interest. And the administration had to make it clear this isn't going to change. And if you want to sell your semiconductor products in the United States, you need to make them in the United States. And that's why it's not a coincidence that we got that announcement today. And TSMC has been aggressively building out its capacity in the U.S. They're uniquely qualified to make these chips. It is very hard to do so. And the administration wants them to do that in the U.S.
I got to ask you, Gil, while I have you about Nvidia, because I know you've been on the sidelines there. I'm looking at this chart, though, Gil. I mean, this stock has now been shelled. It's down almost 25% year to date. I'm curious, given that move, how does valuation look now, Gil, for Nvidia?
Well, if you asked me a couple of days ago, I would have told you that it looks pretty balanced because the upside was pretty substantial. If you believe consensus estimates for next year and you put a historical multiple on that, the stock could go to 160. If you don't, if you think that CapEx is going to roll over this year, and this is peak year, then and you put a lower end multiple on that, the stock could go to 80. And so as of a couple of days ago, that was a pretty balanced risk reward. But based on everything we just talked about, if I'm Microsoft, if I'm Google, if I'm Amazon, if I'm Meta, and I'm looking at my core product getting weaker, investors already being concerned at the rate I'm investing or over investing in CapEx, I would think that we need to revisit that CapEx outlook that just a few weeks ago looked set to be up 40, 50% over last year. I would think that as we hear from these companies, we're going to hear increasing caution about whether or not they're going to deploy all the data centers at the rates that they were previously planning to do.
Gil, we're always lucky to have you on the show. Thanks so much for joining us.
Thank you.